Hello and welcome to FE Explains. I'm Roshun Povaiah. Now, don't panic when you hear today's topic, the Reserve Bank of India's monetary policy, which happens every 2 months. It has you, dear viewer, in mind because it's your interest rates that you pay on your loans that could be cut. Oh yes, on the other hand, the rate of interest that you earn on your fixed deposit may go down too. Well, that's the fine balance banks must strike between your money and other people's money. Hey, everyone wants the bigger, better deal, right? So, this explainer is in 3 parts. 1. What does the monetary policy do? 2. How is it implemented? And 3. What does it mean for you? Okay, so what exactly does the RBI's monetary policy do? Here's a very broad overview just to put things in perspective. You see, the RBI's primary objective is to maintain price stability in the economy and control inflation within a target range. Currently, it's at about 4%. It can do this by regulating the amount of money supply. At the same time, the RBI has to promote economic growth, ensuring credit availability for some of the more productive sectors of the economy and also for MSMEs and infrastructure. This also helps employment growth. Next, the RBI also must ensure financial stability, so it keeps a hawk eye on banks and financial institutions to ensure all their systems are in order and they are following the rules. And here's one for you. The RBI has to encourage savings and investments. If it pegs higher interest rates, you are likely to park your money in a fixed deposit. If the rates are lower, you are likely to invest your money somewhere else where you will get a higher return on your investment. You see this delicate balance now? That's what I'm talking about. It's all about demand and supply. If it expands credit and lowers interest rates, there will be a boost in demand and this can spur the economy. But if inflation begins to spike because of more money chasing the same amount of goods, it can turn off the tap. That is, it can raise interest rates, trim credit, and control inflation. So how does the RBI go about implementing this monetary policy? And why should you keep a close watch on it, especially if you're in the middle of repaying loans? To understand how the policy is implemented, let's first look at a few terms. One is the repo rate, or the interest rate at which commercial banks borrow money in the short term from the RBI against government securities as collateral. An increase in the repo rate makes borrowing more expensive for the banks, and this means loan interest rates are also higher for you, the consumer, and for businesses as well. This reduces the money supply and curbs inflation. The second is the reverse repo rate. This is the interest rate at which the RBI borrows money from commercial banks. When banks have excess funds, they can deposit them with the RBI, which pays interest on these deposits. This is the reverse repo rate. If the RBI increases the reverse repo rate, it encourages banks to deposit money with the RBI, thereby reducing the amount of money that they have for lending. That is, it absorbs the excess liquidity in the system. That brings us to the third term, which is cash reserve ratio, or CRR. This is a percentage fixed by the RBI on a commercial bank's net demand and time liabilities, or NDTL, which is the total funds a bank owes its customers, including deposits like savings accounts and fixed deposits. This determines the amount of money in liquid cash that a bank has to lend. A higher CRR reduces the amount of money that the banks have to lend. So, the current cash reserve ratio as of last monetary policy in April is 4%, meaning if a bank has 100 rupees to lend, it has to keep 4 rupees with the RBI. Mind you, the CRR doesn't earn banks any interest. The fourth term is statutory liquidity ratio, or SLR. It's similar to CRR, but this is a percentage of liquid assets like gold, cash, and government securities that banks have to maintain with themselves. Currently, that is at 18%. A higher SLR means less lending capacity for the banks. Then there's OMO, or open market operations, which is another lever for the RBI. This is the buying and selling of government securities, basically the bonds that you buy. If the RBI sells securities in the open market, it absorbs liquidity in the market and vice versa. There are many more tools that the RBI has to implement its monetary policy. But for the sake of brevity, let's limit it to these few for now. The RBI's Monetary Policy Committee, which meets every few months, has to tweak all these levers to fix the benchmark policy rate, the repo rate, to achieve this inflation target. This brings me to the third aspect of this explainer. What does the RBI's monetary policy mean for you? Well, if the RBI cuts its repo rate by 25 basis points or 0.25%, the repo rate will drop to 5.75%. This is something that banks should pass on to customers who have loans with them, but they usually don't do that immediately. Why is that? Okay, two more terms for you: EBLR and MCLR. EBLR is the external benchmark lending rate, which is the case is directly linked to the repo rate. MCLR, on the other hand, is the marginal cost of funds lending rate, which is what most banks use, as it takes into account the bank's cost of funds, their overheads and electricity, etc. Now, most loans are usually linked to the MCLR, unless you're one of the lucky few who has it pegged to the EBLR. So even if the RBI cuts rates today by 25 basis points, it will take your bank a little while to reduce your loan interest rate. On the other hand, interest rates on fixed deposits, which is what the banks will have to pay you, will be reduced almost immediately. That's how their businesses work. Still, it would be best to talk to your bank now and get that lower interest rate. How much lower can interest rates go? Well, experts and multiple surveys say that the terminal rate, or the maximum that the RBI will cut rates in this policy cycle, is down to 5%. So yes, you can expect further interest rate cuts, which is a good thing. This is because inflation is likely to stay below 4%. Food prices will remain moderate on the back of a good monsoon and a strong winter crop harvest, and there is an expected lower price of inflation due to pulses having higher supply. Overall, you, the consumer, will stand to benefit from the monetary policy in the next few months. Like and share this video, and of course, follow financialexpress.com for more news that you could use.